Welcome back. The market's holding mildly in the green. GAIL is the one which is doing a bit of batting right now. Currently at the high point of the day from the frontline space, we have GAIL. The intraday chart of that one should come up for you. Along with that, the stocks which are though seeing a bit of a slip are the oil marketing companies, BPCL, IOC, both of them at the low point of the day. And we have Maruti Suzuki seeing a bit of sell-off as well. So we'll keep an eye out on how the markets go. From the financials, we have Bajaj Finserv, which is witnessing a pair of profit taking currently at the low point of the day. But talking about financials, let's shift focus now to the Morgan Stanley India Summit, where our colleague Nimesh Shah is waiting with Anil Agarwal, who's the head of Asian Financial Research at Morgan Stanley. Nimesh.
I think Nimesh is waiting by with the guest. Nimesh, are we audible?
Yes, Nigel, I'm audible to you. And yes, I'm having with me Anil Agarwal, the Asia banking analyst with Morgan Stanley from the sidelines of their India Summit. He tracks the Indian financial sector very, very closely. And, he wrote a very big report yesterday about large banks. I'm going to start asking about large banks first. Anil, thank you very much for talking to CNBC TV 18. I was reading a report on large banks. Despite a big run-up, you feel it's going to be a compounding machine for the next few years. Take us to this large bank theory and why you are so bullish on the four large banks in India.
So we have been bullish on these for the last year or so. In fact, last year we had written this report that it's now a matter of time, and the call was that the asset quality cycle is likely to be behind us in 12 months because state-owned banks have been recapitalized, banks were recognizing NPLs, provisions were being made, and that's what played out. I mean, multiples have expanded. Our view is that NPLs will keep coming down, but that's broadly in the price of the large banks. The thing which is likely to drive performance for the next few years is earnings growth. So if I look at it for the large banks, we are quite bullish on asset growth. So the asset growth, depending on the bank we are talking about, can be between 15 to 25% compounded for the next 2 to 3 years. If you look at net interest margins, competitive intensity in India has clearly reduced. So if you look at RBI's data, private banking lending spreads have gone up by about 50 basis points in the last 9 to 10 months. So you have a asset growth coupled with margin expansion. Cost, because of technology adoption, is unlikely to grow at more than 13 to 14%. So we are building in 22 to 25% pre-provision earnings growth, which is actually, if you compare that with global financials, if you compare that with regional financials, there are very few banking sectors or large banking stocks which generate that return. So our view is that investors will look at this if we are correct about our earnings estimates. One is they become compounders, and given where the multiples are, given the fact that interest rates are coming down both globally and in India, you can actually have multiple expansion too.
Anil, if I'm not wrong, I also read one report where you spoke about looking at historical data and the fact that in the past history you've seen some similar cycles and similar valuations, and from there the stocks have gone up 3x, 5x, 8x. Is that the cycle that you're talking about now, that many of the stocks will become 4x, 5x, 8x from now?
No, we're not saying 4 to 5x. We are more like it's more about 25 to 50% return over the next 12 months, and then they can compound. Okay. For 4 to 5x, you need a global reflation cycle, because what happened in the last cycle was that NPLs came down at the same time everywhere, whether it was emerging markets, whether it was commodity prices, everything was reflating. Economics team is not that bullish. I mean, Chetan was on TV this morning. So unless we see that kind of global backdrop, I don't think you're talking about excess. Okay. It's more about going up by 25 to 50%.
So do you think even with moderate growth for the next 1 year or for next 4 quarters, still you hold the view that these stocks can give at least 40-50% returns, primarily on the back that NPLs have been recognized and now it's only about growth and cost coming down?
20 to 25% pre-provision profit growth in the world of financials is not moderate.
Right.
I'm
talking about moderate economic growth.
Moderate economic growth. And so the thing is, what we are saying here is that if you go back to the last cycle, Nimesh, everything went up. Right. Whether you're a large bank, whether you're a small bank, everything went up. In fact, right now, if you look at our recommendations, we can't talk about individual stocks. Sure. We have more underweights than we have overweights, because our view is that this is not the cycle of the past where everything kind of reflates. Right. The weak will become weaker and the strong will become stronger. Right. So the strong guys can actually report that kind of earnings growth even in a kind of a slowish macro. Okay.
Is that the call that within the PSUs, the only stock I can see in your recommendations is SBI? What's your broad view on the PSUs? Are they going to continue to lose market share and in terms of multiples as well?
So generally PSU banks we don't like, because our view is that, so the good thing is the recap which was done with these state-owned banks a couple of years back last year that was more than enough to kind of compensate for NPL recognition and provisioning, but they don't have capital to grow. So if you look at their loan growth, we are building in, the largest bank, we are building in about 5% loan growth every year for the next 3 years. And so unless they get capital for growth, because if you're growing at, you don't have enough ROE to grow faster, so unless they get capital for growth, unlikely to see a stock story there, stock price story there.
Okay. The other big sector which is being so much talked about, and there is so much of fear now, and so to say crisis as well, is the NBFC sector.
Yeah.
But you have a slightly different view. You feel that some bit of liquidity is coming back into the system now. What's the general view on NBFCs at this point in time?
So the thing is that everybody classifies the whole NBFC bucket together. So people look at like, okay, so much of mutual fund redemption is due from NBFCs. But you have to segregate into what we call long vintage, strong parentage NBFCs and others. And 2/3 of all NBFC book is actually the bigger guys who have been in existence for 10, 15, 20 years. And I don't think they are facing challenges. They're still able to access funding at a reasonably good cost. The problem is with the NBFCs or housing finance companies, which actually grew very aggressively in the last 3-4 years. That's where the problem is. That's about 1/3 of NBFCs. So we are not positive on them. We think that they will continue to struggle to get longer tenor funding. But the big guys actually, for them, if you look at the funding cost, it's the funding lending, the spreads have gone back to where they were closely to where they were in September.
In September 20, correct.
So again, as I said, in the banks you have big getting bigger. Similarly, in the wholesale funded space, I think if you're big and the market trusts you, the funding market trusts you, and there are quite a few of those, they're going to gain market share.
So how are you looking at this whole liquidity crisis because of Diwan housing, because of Island Affairs? Where are we in the cycle right now? Are we at the end of the crisis, or we are in the middle of the crisis? What more pain can come? My whole point is what more we need to watch out for in terms of liquidity crisis for NBFC sector.
So I think the problem, one of the issues with India, what's happening right now is that the guys who have capital and deposits, they are all concentrating on one segment, which is either retail or higher rated corporate. So everybody is lending to A-, AA, AAA. Nobody is lending to BBB and below. So the issue is that the guys who are lending to the BBB and below were the sort of weaker NBFCs or wholesale funded banks, etc., and they're not growing anymore. So what you need to do is, if they don't get credit, if they don't start getting credit, it will become an issue at some point of time, and then obviously it will subsume other players. So I think the policymakers need to start to get credit going for the BBB and below sector.
Okay.
Yeah, if that doesn't happen, then we have more to go.
Okay. But what about smaller NBFCs? I know you have some stocks under coverage, like Edelweiss in the past. Generally, what's the view on some of those smaller NBFCs where there is a bit of a liquidity crisis, but they have good assets to back on, or maybe they can raise funds as well. How are you positioned into those kind of NBFCs?
It's very, very stock specific then. Okay. If we see that, so from an earnings perspective, obviously the smaller NBFCs will struggle. But if we see for a particular stock that they are actually able to raise equity or they're able to raise enough funding, obviously earnings will be under pressure, but at least if I look 2 to 3 years out, they can do well. So depending on where the valuations are, they can become interesting.
Okay.
But there are certain other stocks where obviously funding cost has moved up a lot, so they need to right-size the balance sheet much more aggressively. Unfortunately, I can't talk about individual names, so I think it's, again, I won't put all the smaller NBFCs in one bucket. So there are a couple of smaller NBFCs we actually don't have a sell on.
Sure.
Because we think that they are actually managing the balance sheet reasonably okay. Yeah.
Okay. The other big talking point has been the regulatory framework for many of these NBFCs and banks as well. Kotak is stuck in a regulatory environment. A lot of these NBFCs need to have a different structure, so the Equitas and the Ujjivans of the world, the small banks of the world. Within that regulatory framework, the kind of challenges many of these banks and small banks have, anything that stands out to you within the small banks that you think is poised enough to capture the growth from the fall of NBFCs and PSUs?
No, so actually the thing is, even as a small bank, a bank can get funding at a reasonable rate. As I said, funding cost is coming down for any wholesale funded entity where the credit market is actually confident of long-term solvency, or what do you call it. So if these small banks can get funding at a low rate, it's great for them because there is loan demand. I mean, there is a part of the lending book which nobody is satisfying right now, which is not the A minus to AAA category. And these small banks by definition would not be lending to AAA and AA because they cannot compete with the larger banks at funding costs. So again, that's a space, depending on the stock we are talking about, should be, there are some names that should be able to do very well there.
Okay.
Yeah.
Okay. I didn't see much of coverage on the small banks, so to speak. We spoke out briefly about the small banks, but are you getting a sense that there is enough room for some of the small banks to really capture the market share and actually capture the mind space as well in terms of investors positioning into those banks, at least from a medium to long term perspective?
So if you look at the challenge financials, or what we call challenge financials, so one of the banks, some of the wholesale funded institutions, in 2018 they were 25% of the incremental lending growth in India.
Okay.
And that's the part of the book which I don't think the big banks are actually lending to. So from a lending perspective, the opportunity for the small banks I think is there. It's more about what is the cost at which they are getting funding, whether they are getting funding, because they are also wholesale, right? I mean, they have retail access, but they have quite a bit of wholesale funding. So are they able to grow that funding, long-term funding or not? If they are able to, I think from a loan demand perspective, I don't think there's a dearth of loan demand.
Okay.
I think there's enough loan demand.
Before I let you go, Anil, last question. If we're going to see further rate cuts from RBI, and generally the trend is going to be lower rates, broadly from a financials point of view, which segment you think will benefit the most in the next 4 quarters from now?
So the thing, it's again, it would be wholesale funded institutions, which can actually benefit from that funding cost coming down. Because the problem with India is that while RBI has been cutting rates, if you look at the banks, they have not been cutting deposit rates because deposits are not growing. So if banks are not cutting deposit rates, how do you bring down the cost of capital? Cost of lending. So if rates keep going down, then the wholesale funded institutions which have access to funding, for them it's great. So which is it's an interesting time. There's a lot of alpha opportunity in these banks and NBFCs.
Anil?
All right, then wholesale funded institutions, they hold the edge, it seems. That's at least the takeaway in terms of that conversation that Nimesh did have out there at Morgan Stanley. In terms of our own markets, well, need to keep an eye out on a few stocks. BPCL has moved to the low point of the day. So that stock should come up for you on the screen. And we have the May CM data, not looking too great. We have most of all of these numbers with us. You have Maruti that's moved to the low point of the day. So most of these numbers are already with us. The auto index on the whole has come off the high point of the day. Slip into a short break, come back, continue our focus on the markets as well as a whole host of stocks.